Welcome back to the Personal Finance Project. Today, Scott and Greg are doing another segment on things you pretend to know. This week, they will be discussing mortgages, how mortgage rates are set, what moves mortgage rates, and other common misconceptions. Scott, what's your mortgage rate?
2.5. Greg, what's yours?
6.5.
A little bit has changed in the last few years, I'd say.
And I think as the things you pretend to know, kind of mortgages, mortgage rates, how they're set, what they mean, this is actually a good starting point because you issued your mortgage in 2021, if I'm understanding that right.
Yes.
I issued mine in 2023. Now, in principle, they are similar, but there are some key differences. The first of which is mine's a 30-year conventional fixed rate mortgage. Yours is a 15. So you probably saved a little bit on your interest rate, or your lender was willing to provide that loan to you at slightly less interest due to the short-term nature of the loan.
That's not going to move it 4 percentage points, though. So
Certainly.
that's maybe quarter percent.
Yeah. So if we were like 30-year, 2021 to 2023, we might be talking about a 3 at the max to a 6.5 now.
Yeah, something like that.
And so I think a lot of people might go to, well, the Fed has continued to raise rates on the very short end of the curve, the overnight rate, the only rate that the Fed can really directly influence, and not even influence set. They can influence other longer term rates. But I think this is our first common misconception, is the Fed has raised that rate, the only rate over which they have control. And that is really what's pushing mortgage rates higher and higher.
Yeah, I would say that the big misconception here is that the Fed has some direct control. Like they're deciding, all right, well, now we've got 7% rates. You hear a lot about 7 is kind of the new 6.
Right. Yeah.
In terms of mortgages,
I regard myself as lucky at 6.5 now.
Yeah. No, it doesn't look bad in the grand market of things where we are right now. So I think that the misconception is the Fed decided that mortgage rates are 7 now. And what the Fed has done is that if we just roll the clock back a little bit, in 2021, when I got this, historically low mortgage rate, what was the reason for that was that rates were super, super suppressed because of COVID, but we were right on the precipice of huge inflationary pressure from supply chain problems, quantitative easing, rates being basically just too low for too long.
Right.
I mean, and that could probably be another podcast where we just talk about how we managed to have 10 years of 0% interest rates and didn't have inflation problems sooner.
Right.
That's probably another episode.
And I think when you're talking about rates being super low in 2021, which rate is important? Because the 10-year Treasury was also like at the nadir, the very bottom, was at 50 basis points, 60 basis points, something like that.
Yeah, so somewhere and that was the time when we were talking about foreign sovereign debt like Japan and Switzerland being negative.
Right.
Where basically you are paying to deposit your money in these bond securities for 5 to 10 years.
It's a bit like in Soviet Russia, you pay the bank.
Yes, yes.
Pay you.
It's great benefit to let them hold your money for you for 5 years.
And the reason I point that out is we try to counsel people on saying, the Fed can influence longer term rates somewhat directionally by changing the overnight rate. But that 10-year Treasury rate being at 50 basis points, we can see in your case the historic spread, or essentially the difference between the 10-year Treasury and prevailing mortgage rates, has been about 2 to 2.5%.
Yeah, and actually what I was just about to kind of touch on was if you really want to kind of get an idea of where your mortgage rate should be, look at the 10-year Treasury, not the Fed rate, and add 2. That's a starting point.
Right.
Right now, the 10-year is about 4.5, maybe a little bit higher. Add 2 to that, you get to 6.5. I think that the other part of mortgage rates that people need to consider is the rest of it is an expectation on where rates are going from here.
Right.
So I think in just the last few months, what we've had is that people have gotten a little bit concerned that tariffs are either going to lead to recession or some new bout of inflation. We've had a couple of podcast episodes talking about potentially tariff-related inflation concerns. So maybe that difference between 6.5 and 7 where we are is people being a little bit unsure. Could we go higher still in terms of rates to fight inflation when the Fed has actually cut rates a few times since the end of 2024, mortgage rates have pretty much been unmoved by that.
Right. And I think that you can get some dislocation in that historic average between 2 and 2.5 in times of uncertainty. And that has a lot to do with the mechanics of the mortgage-backed security market, which is if interest rates go higher, nobody refinances their home. So it's not like you're all of a sudden going to be reissuing these mortgages at higher rates. That would be insane. Except for, of course, if you have, twins accidentally and you need a large property, then in which case you move yourself from a happy 2.9% mortgage to where I'm at now, 6.5%. But generally speaking, if interest rates drift up, people do not refinance their homes. However, if interest rates decline, now all of a sudden, if you're the owner of a mortgage-backed security, you're having to contend with prepayment risk. So you're not really going to benefit from those higher cash flows, those previously higher rates, as long as you would if you owned a plain vanilla 10-year Treasury. Because if rates drop on the 10-year Treasury, not only do you get a little bit of a boost in the underlying value of your security, and that's largely due to the fact that you've locked into those higher rates, no one's prepaying those. They're not callable bonds. And so this brings us to the question of there's a bit of the tail wagging the dog, whereas the mortgage-backed market, people who own that mortgage debt, they don't have as much what is called convexity as you would in a 10-year Treasury, which means that spread in times of uncertainty is going to have to widen because they're a little bit more sensitive on both sides of that interest rate move. They don't benefit nearly as much when rates fall, and they get hurt when they go up.
Yeah, and I think that's actually a good kind of a stopping point to do another things you pretend to know or just a clarifying component here.
Sure.
Is mortgage-backed securities. These got a lot of pub in 2008 and 9 with the financial crisis and mortgage rates. Basically what these are, it's a basket of when you go out and get a mortgage, the issuing bank, basically they puts them into a bundle or a basket and then sells them to the market as a security where over the course of your repayment and maybe hundreds of other people's repayments of their mortgage, the owner of this, they're typically bundled by somebody like Fannie Mae, Freddie Mac, Ginnie Mae. And so what they're going to do is you're going to get your principal and interest back as the individual borrowers pay their principal and interest back.
Exactly.
In the financial crisis, those got a lot of pub because of the fact that by putting a whole bunch of lower quality mortgages into a basket, a lot of the credit ratings agencies seem to look past the fact that these individual buyers were quite risky.
Yes.
When you consider the fact that maybe their income was low or their assets were low for the amount of debt that they had outstanding.
And loan to values were insane. We're talking about virtually zero money down. We had very interesting, let's say, mortgage vehicles back then where you could have a teaser rate, say, of a very low interest payment, and then all of a sudden it ballooned to your standard payment and you had to start paying principal. So there was all sorts of, financial machinations going on in these, securitized loans or these baskets of securitized loans that I think some regulation has definitely helped there. And so I don't know, I guess I can get your opinion on this, if we're at risk of something like that happening again with the mortgage-backed market.
I don't think so based on what I read. And the main reason for that is I don't think that you can borrow nearly as much with very low income. I don't think there's ways to gamify your interest rate for, say, 2 or 3 years to get into a house relatively free and then just understand that you're going to get foreclosed on in a couple, 3 years. Nobody does that.
Yeah. And I think another question the listener might have is, you're telling us that mortgage rates are very intimately intertwined with 10-year Treasuries, but aren't most mortgages 30-year mortgages? And that, I think, is a thing that I pretended to know until recently, where I did not realize that most 30-year mortgages, like the effective duration of a basket of 30-year mortgages, is actually closer to 10. And that's because a lot of people do either refinance or prepay their mortgage, whether it be they come into a little bit more income as that first decade of owning a house kind of rolls off, inheritances, all sorts of things actually mean that the average length of the mortgage contract within a pool of 30 is closer to 10. And then if you think about that, it's like, oh, okay, I see why they would be more closely intertwined with where the 10-year Treasury is trading.
Yeah, and I think the other thing that's interesting is right now, if you look at a mortgage-backed security, the implied duration on them, I would say argues it looks the longest that it has in probably 40 years, because what's basically happened is interest rates kind of peaked in the early 80s. They've been going down for 40 years pretty much across the board. We haven't talked about the yield curve a lot, but typically the longer you're borrowing money for, the more interest you're going to have to pay.
Exactly.
So if we think about it in terms of the direction across the board, rates have been going down. People have been refinancing all along the way, or buying new houses, paying off old mortgages. Now, I think what you find is there's tons of people like you, Greg, who, if we got a big pullback down, would refinance
right away.
And so we could very quickly have the duration of those mortgages go from 15 to 5 or less, maybe.
Yeah, so I think for the benefit of the listener, what you're saying is implied duration of the mortgage-backed security market is at a historic kind of peak, because there are so many people like you who locked into a very low rate mortgage in 2021, and you have no intention of prepaying that mortgage.
Yeah, basically everybody who has a mortgage is not going. There's fewer people who are imminently looking to move to get out of their current mortgage for a better one on the outside.
Or even with clients like we have, if they happen to get into a mortgage that is way below where prevailing rates are now, and way below what they could earn on a plain vanilla 10-year Treasury, we're just doing a simple arbitrage calculation. It's saying, well, why would you liquidate some of your holdings on which you get a risk-free, and I'm putting this in scare quotes, I guess, for compliance purposes, although a 10-year Treasury issued by the United States is still risk-free.
Yeah, and
actually
could get
a little bit gyration in the price.
Now that we've been downgraded, I believe that mortgage backs and the U.S. Treasury have the exact same credit rating, AA+.
Right. True. But you could get a risk-free with gyrations in the underlying value, but you could clip close to 5. Why would you then liquidate that asset to pay off a 2.5% mortgage? It doesn't make sense.
No.
So you've got this sort of coincidence, I suppose, where very few people are refinancing because rates have only gone up. I can't imagine who might be refinancing now or for what reason, aside from if you had to move. And then very few people are prepaying because financially it just doesn't make sense. And that's going to extend the duration or the effective duration of a typical pool of mortgage-backed securities.
Well, and I think that this is why you're constantly seeing articles and hearing reports about, are we in a real estate bubble, or what is going to get the real estate market going again? And it's those exact same reasons. It's if you have, say, an expensive house that you like at a 2.5% mortgage, unless you probably pass away, why are you going to give that up?
The impetus to move isn't there.
Yeah, there's just no impetus to move because your borrowing costs are going to be so much higher. I think, and then the other issue is just the affordability on the lower part of the curve. I think our listeners and anybody would just notice that what you consider a starter home price has gone up very dramatically since COVID.
Oh, considerably. Yeah.
Yeah.
Absolutely. So, I mean, I think that's really nice is we can tie that into saying the mortgage-backed market is very intimately intertwined with the 10-year Treasury rate. And since that rate has gone up so much, we've maintained this historic spread of basically, 200 to 250 basis points, or 2 to 2.5%. for the benefit of the listener, but that spread might be drifting ever wider based on the fact that, well, I suppose if you were in the mortgage-backed market and now prepayment risks had come down, you might be willing to say, well, I'll take a little bit less of a yield here because the risks have come down. However, what's militating against that has been the volatility of that 10-year Treasury rate. So it's kind of an interesting situation.
Well, and I think part of it also is this kind of just I don't know, people maybe overblown this concept, but the sell America trade that people are talking about right now, which is, hey, is the U.S. being very responsible with its debt obligations? Not really. I think is the general view is that we're not doing a ton to address our deficit. And when that's the case, it's kind of hard to argue that we should only have to pay 2.5% for long-term debt.
Well,
and so people are saying,
right.
I want you to pay me more if I'm going to buy these things.
Right. So as demand, or as I would say, not demand for the Treasury itself, but as we're trying to entice demand, and your only tool in the toolbox to entice people to buy your debt would essentially be to offer them higher cash flows for having done so.
Yeah.
And so as the rate of that 10-year Treasury continues to drift up in the face of refinancing or prepayment risks coming down on mortgage-backed securities, you have this really interesting interplay where I think it's kind of confusing. It's like, where should rates on mortgage backs go, knowing that, hey, again, I'm probably going to do better long term if we think rates might eventually come down on the 10-year if I own a plain vanilla Treasury, for the reasons we talked about before. Because if that comes down, you don't suddenly get prepaid. You don't get that called away. But now you think, well, could rates continue to drift higher and higher on that? And would I be better off in a mortgage back, clipping slightly more and having a little bit less exposure to rising rates?
Yeah.
Because people wouldn't be refinancing or prepaying under those conditions either. And you probably wouldn't be hurt quite as much because so much more of your return is coming in cash. That's a confusing element.
I mean, this is the same phenomenon as what happened to Silicon Valley Bank and Signature Bank a couple of years ago. It's, you have this big pool of whether it's mortgages or bonds, and they are the thing upon which you maybe make loans or get interest payments. All of a sudden, the value of those things is drastically different because of a huge move in interest rates. You're okay as long as you don't have to liquidate anything.
Right.
It's this kind of the same, it's what we talk about, having something that's not supermarket oriented that you can sell so that you're not having to sell stocks that are down 30%. It's the same phenomenon with bonds here. It's just people for the longest time didn't feel like bonds could move that much.
Yeah, and I think there's a lot of, misinterpretation there where Silicon Valley Bank was insolvent on paper, but it wasn't really insolvent in principle, because given a long enough time, that would have worked itself out.
They were insolvent because people asked them for the cash today, which required them to sell assets that were down 25% when they bought them.
And the interesting thing about having long-dated bonds on your balance sheet that have now been completely clobbered from a price perspective because interest rates have gone up so much is, if you think about the components of the return for that part of their portfolio, people forget those are making semi-annual coupon payments. And then what are you doing with those? You are now having the privilege of reinvesting them at higher rates if given adequate time. Rather than having to pay them out to investors who are itching to get their money, I can appreciate why a person might do that. But the long-term total returns on the bond, seen more comprehensively, given the opportunity to reinvest the cash flows at higher interest rates, actually is going to be a little bit better if you allow that underlying value to move ever so slowly back toward its par. Mm-hmm. And I think people can get that element of investing just in bonds generally, kind of far afield from mortgages here. That can be something they could trip themselves up on too.
Yeah, I think you're definitely right there. One final thought, I was just, you were talking a little bit earlier about the tools that, say, the Fed or anybody has to affect mortgage rates. The other one that we saw quite a bit after the financial crisis to try to stabilize that market, and then for several years thereafter, was what we call quantitative easing, which was not necessarily trying to direct mortgage rates with interest rate movements, but by actually buying these mortgages through the open market.
I was hoping you would touch on that.
Yeah, so the Fed going out and putting some of these mortgages on the Fed balance sheet, the government balance sheet essentially, to try to lower rates and take some of that supply off the market. You could argue that if the Fed really wanted to get rates lower, they could start doing something like that.
Yeah.
Because as they put in a bid that is higher than what's out there right now for some of these securities, those rates will start to drift lower. But I think it's counterintuitive for some of the other things that we were just talking about. The debt load of the government is already high. So we're going to spend more money to put these mortgages on the balance sheet that, are not going to get a return that's above the interest payment that they're going to have to pay on that new debt.
Right.
So I didn't know if you had any other thoughts on the
I think that
open market.
I think that if we can bring the listener back to how closely related is my mortgage rate going to be to the actions of the Fed? And it's like, it's a yes and no question, because I think you alluded to this on a previous podcast where you said there's been this sort of puzzle of finance for a long time where the very, very short-term rates that the Fed can control tend to influence, for whatever the reason, 30-year fixed rate mortgages, despite the fact that many, professors of finance, economics professors have said this doesn't make sense. Like, what is going on here? And I think from our perspective, it's like, it doesn't make sense, but it's still a reality that we have to face. And so I think if I were counseling a person on they're trying to buy their first home and directionally saying, does it make sense to continue to rent for a while, hoping that these rates will come down? Because I won't say it, but because there's been some political pressure for the Fed to drop short-term rates. Do you think that that's a kind of a pie in the sky deal where, if they drop their short-term rates, then mortgage rates should immediately adjust and I'll be able to get in on a 2.5 like Scott Bartosh did? Or do you feel like maybe going ahead and biting the bullet, buying the home now and then refinancing later is probably the better move?
I'd probably lean towards the latter. And the main reason is, recent evidence. The Fed cut rates 3 times at the end of 2024. And rates are basically where they were.
Right.
So we're finally getting a little bit of separation between mortgage rates and what the Fed is doing. And I think that all boils down to the other component of this is direction. We talked a little bit about it before, but I think right now people are in the general belief that rates are higher for a little bit longer. And so even when the Fed moves something, it's this expectation that, I just don't know if we're out of the woods on inflation yet.
Yeah, and I think if we do because there are some strange instances where you can actually refinance a somewhat what people would regard as a riskless debt. Well, this was a lesson we learned during the financial crisis, that 30-year mortgages, even from people who had sufficient income, were not riskless. But say we get rates on the short end of the curve that do come down dramatically, and then things like asset-backed loans start to look attractive again.
Yeah.
These were things that people did during COVID. I mean, we were issuing, I won't say how many, but these were very attractive loans because rates were near zero on the shorter end of the curve. So when you use something like LIBOR or the SOFR rate plus a spread, you could see a situation where a HELOC might actually have a better interest rate than your mortgage if you were like me and locked in at a 6.5.
Yeah, so that's an interesting phenomenon. A home equity line of credit, lower rate than your primary mortgage. And then I think the other one you mentioned was another asset back. So if you have investments, you could borrow against them. Typically, people talk about margin rates. Those tend to be a little higher.
Yeah.
There's other rates that if you borrow on assets, you could get a little bit lower rate on.
Yeah. So it could be the case where you say, hey, even if you do lock in at the 6.5% or 7%, if you get a prevailing mortgage now, there might be some interesting opportunities in the future if you've got other assets, or if you can build sufficient equity in your home where you might not have to go through the whole underwriting process again and have your phone blowing up for 3 days because your information has been sold to everybody who's ever done a mortgage ever. And I've done this a couple of times and it's certainly not fun, where you can actually arbitrage your own loans by just taking a loan that's slightly different properties than your mortgage.
Yeah.
Using that loan to pay off your mortgage and then paying down that at a lower rate. So there's some market gyrations that might happen in the future that may say, go ahead and buy it. And I'm certainly not in the camp of buy it for the tax deduction, because that's probably the topic of a whole other episode.
I was going to say other topics that I think we can build on from here would be looking at your home as an investment, which I think the general view, especially at 7% mortgage rates, is I probably wouldn't do it. Right. I mean, do it to the extent that, you're not thinking about it. Don't go into, well, I'm going to spend extra on this house because it's an investment. Probably wouldn't do that.
Or because the mortgage is tax deductible.
Yeah. No, well, and I mean, that's, again, another podcast that we could do on
for sure.
The SALT exemption going up, but who does that actually help in a state like Texas?
Yes, very few people. I think that that's the topic of another episode. I think maybe we'll do with our financial mythbusters, your residence as an investment. That could be a good one. So stay tuned. Yeah.
Stay tuned.
Thank you for listening to another episode of the Personal Finance Project. This show would not exist without the help of our brilliant creative director, Kira Minifield. Kira, thank you for everything you do to keep this show running. On to the disclosures. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value, NAV. Baird does not issue or underwrite mortgages and does not service mortgage lending services. Any references to mortgages in the financial services offerings are purely intended to convey an engagement in this holistic planning process, with this as one piece of the larger picture, which may or may not apply to all clients. This broadcast may not be reproduced without express permission of Robert W. Baird & Co. Incorporated.